A letter from a stranger quietly announcing that the bank has taken your home. For roughly 367,000 American families last year, that was not a plot twist in a movie. It was the final chapter of their real-life housing story. Institutions keep calling this a return to normal, but the data shows something very different. A slow, uneven squeeze that is hitting the most fragile homeowners first and tightening a little more every single quarter. Right now, the cracks in the housing market do not begin with plunging prices. They begin with missed payments. In the final quarter of 2025, the national mortgage delinquency rate climbed to roughly 4.26%, marking the sharpest quarterly increase seen in years. On a chart, that might look like a small bump, but inside that number is a story that should worry every recent buyer in America. The damage is not spread evenly across all borrowers. It is clustering in the exact corner of the market that was supposed to help people get into homes safely. Loans backed by government programs designed for first-time and lower-income buyers are now posting delinquency rates above 11%. That means more than 1 in 10 of these borrowers is behind on their mortgage, and the share who are 90 days or more past due is rising fast, signaling that many are not just late, they are slipping into a zone where catching up becomes brutally difficult. These loans make up less than a fifth of all outstanding mortgages, yet they account for the majority of the year-over-year increase in delinquencies. In simple terms, the new wave of stress is not starting with wealthy coastal speculators. It is starting with working families who stretched to buy their first place during the most hostile affordability window in recent memory. At the same time, foreclosure activity has been grinding higher. Over the course of 2025, lenders and courts processed filings on roughly 367,000 properties nationwide, a jump of about 14% compared with the previous year. On paper, that figure is still only a fraction of the more than 3 million filings recorded at the peak of the 2008 crisis, and that is exactly why many analysts feel comfortable calling it a normalization from the artificially low levels seen during pandemic-era protections. But numbers do not have to revisit old records to be devastating on the ground. For every additional family that crosses the line from delinquent to foreclosed, normal feels like a cruel joke. To understand why this moment is so dangerous, it helps to remember what made 2008 so catastrophic and how today is different. Back then, the housing market was flooded with irresponsible lending, exotic adjustable rate products, and no-doc and low-doc loans handed out to borrowers who often could not truly afford them. When home prices stalled and then fell, millions of owners found themselves owing more than their homes were worth, with little to no equity to buffer them. Inventory exploded to more than a year of supply in some regions, and foreclosed properties poured onto the market, dragging prices down in a vicious spiral. Today, the architecture of the mortgage system looks much sturdier. Underwriting standards are tighter, exotic loan types are less common, and the typical homeowner has built up a meaningful equity cushion after years of price appreciation. Nationally, housing inventory still sits at just a few months of supply, below the 6-month mark often seen as a balanced level between buyers and sellers. From 30,000 feet, the system does not appear to be collapsing under its own weight. But that is precisely what makes this moment so deceptive. The instability is not coming from within the machinery of Wall Street. It is coming from the accumulated strain on Main Street. For many households, the problem is not that the original mortgage payment was obviously unaffordable on day one. The problem is that everything around that mortgage has gotten more expensive since they closed. Property taxes have inched up as local governments adjust assessments and search for revenue. Homeowner association dues have climbed to cover aging infrastructure, rising labor costs, and unexpected repairs. In condominiums, special assessments can arrive like financial grenades, demanding $5, $10, or even tens of thousands of dollars in a single blow to fund structural upgrades or safety retrofits that can no longer be postponed. Then there is the backdrop every family feels, but rarely connects directly to housing risk. Paychecks are not stretching as far as they did just a few years ago. Groceries, gas, childcare, and health costs have all ratcheted higher, chipping away at whatever surplus once existed in monthly budgets. The labor market, while not in freefall, has shown signs of cooling, with weaker private sector job creation in several months and more workers facing unstable hours or lower overtime. For owners with variable rate mortgages, the timing could hardly be worse. As their reset dates arrive, They are finding their monthly mortgage payment jumping by hundreds of dollars at the same moment everything else has become more expensive. On top of all those pressures sits a force the last housing crash barely considered: the cost of insurance in a world where climate risk is being repriced. Across coastal and high-risk regions, insurers have been raising premiums sharply or pulling back coverage altogether in response to more frequent and more severe storms, floods, wildfires, and other disasters. Research groups that advise regulators and major lenders have modeled what this means for mortgage performance, and the picture is sobering. Their work suggests that, over time, foreclosure rates tend to rise roughly 1% for every 1% increase in insurance costs, and under realistic climate scenarios, that math leads to a multi-100% increase in foreclosures over the coming decades. Take Florida as a living case study. In that state, average annual homeowner insurance premiums are already several $1,000s and have seen punishing double-digit percentage increases in recent years. For many households, especially those who bought with thin margins during the post-pandemic boom, that extra bill was the straw that broke the budget. Some owners have responded by dropping coverage entirely, choosing to roll the dice without a safety net because the alternative is falling behind on the mortgage. But a house without insurance in a hurricane or flood zone is not just a risky asset, it is a ticking time bomb. One direct hit can wipe out savings, destroy the property, and leave the borrower unable to pay the lender or rebuild. This hidden layer of fragility is not limited to one state. Around the country, similar patterns are emerging in wildfire-prone parts of California, along low-lying coastal corridors, and in regions where severe weather is becoming more frequent. Insurance is supposed to be the quiet background line item that protects both households and lenders from catastrophic loss. Instead, it is rapidly becoming one of the most volatile components of the monthly housing bill and a silent driver of future defaults in markets that look healthy on the surface. Another reason this new foreclosure wave is so hard to see clearly is the way distressed inventory is being handled. During the last crisis, banks, servicers, and government agencies dumped vast numbers of foreclosed properties onto the open market. Anyone scanning listings could see the carnage in the form of endless bank-owned and short sale tags, and prices adjusted brutally as that supply overwhelmed demand. This time, a meaningful share of non-performing and reperforming loans is being bundled and sold directly to institutional investors, never showing up as for-sale homes on public portals. That keeps official inventory numbers lower and cushions neighborhood price statistics, but it does nothing to reduce the number of families quietly pushed out of their homes. All of this has three major implications, depending on where someone stands in the housing ladder. For current homeowners, especially those in climate-exposed or high-tax regions, the most important step they can take is brutally simple: calculate the true, all-in cost of owning their home not just today, but under realistic scenarios a few years from now. That means stress testing their budget for higher insurance premiums, higher taxes, rising association fees, and the possibility of income shocks, instead of assuming that a fixed-rate mortgage alone guarantees stability. Owners who see that their margin is already razor-thin have a window of time right now to adjust course before a missed payment turns into a crisis. For investors, this environment is both dangerous and full of opportunity. Markets where inventory has quietly tipped into buyer territory and where cost pressures are flushing out over-leveraged owners can offer compelling entry points, especially for cash-rich buyers who are not as vulnerable to rate shocks. But investors need to recognize that some of the best distressed assets may never be listed individually because they are changing hands inside loan pools and private deals. That means relying only on visible listing data will paint an incomplete picture of where stress is building and where true value lies. For renters on the sidelines hoping for a repeat of 2008, a nationwide collapse in prices that suddenly makes everything cheap, the current data simply does not point in that direction. Mainstream forecasts still call for flat to slightly positive national price growth, with corrections concentrated in specific overbuilt or high-risk markets rather than across the entire country. Waiting endlessly for a crash that never comes can easily turn into missing years of potential equity building, especially in stable regions with strong job bases and limited new supply. The smarter move is to watch the local cost structure, not just headline prices, and to understand how insurance, taxes, and climate risk might shape the long-term math of owning in any given city. The bottom line is that the next phase of this housing story will not look like a sudden wall of for sale signs appearing overnight. It will look like what is already happening: delinquency rates creeping up, foreclosure filings grinding higher, and a growing number of households discovering that the home they could afford 2 years ago has become the home they can no longer realistically carry. The cracks are here. The question is whether the people living and investing in this market will see them in time to protect themselves, or whether they will only notice when the letter nobody wants finally lands in their mailbox.